Hi, welcome to Family Wealth Planning Partners. This is our blog series, and you're in week 2 of a 5-part series around the different account types that are available. Now, today we're focusing on the pre-tax side, which I think most people are familiar with: 401ks, 403bs, simple IRAs, SEP IRAs. We refer to those as employer-sponsored plans. We're going to look at those in 3 different areas: contribution limits, the taxation of the accounts, and then what are your options should you change employment or leave employment. So let's first look at contribution limits. In 401ks, 403bs, pretty straightforward. If you're under the age of 50, you can contribute $19,500. By the way, this is 2019. If you're over the age of 50, you're allowed to do a catch-up provision, which allows you to put in an additional $6,000. In a simple IRA, you can contribute up to $13,000 if you're under the age of 50. If you're over the age of 50, you get a $3,000 additional catch-up provision that you can contribute. And then we have SEP IRAs, which are simplified employer pension plans, which typically use those for individual business owners, sole proprietors, that sort of thing. And they can contribute up to 25% of their total compensation, or a maximum of $56,000. So let's look at the taxation of the accounts. So when we say pre-tax, I think everybody pretty much knows what that means. That means that you're putting money into the account before your paycheck is taxed. The growth of those accounts are tax deferred, meaning when you get dividends and interest and capital gains inside the account while they're invested, you don't pay tax on that. And then when it gets to the distribution phase of life, that's where you're taxed potentially. So we have some clients that their income is just not enough to be taxed, and so they're not taxed on it. But just know that when you do the withdrawals, when you get into the distribution phase of life, that taxation of those accounts is based off whatever your tax bracket is at the time you make the withdrawals. And so it is pre-tax going in, what we call tax deferred growth, and then it's taxable distributions. Now let's look at what happens should you change employment for whatever reason, or you leave employment for whatever reason. You have a couple of options. You can leave the funds in your current employer-sponsored plan. You have that option. You can, 2, roll it to your new employer's retirement plan. You can take a full distribution, which we almost never recommend to do that, but that's an option. Or 4, which is probably the most commonly used practice, you can take your balance in an old 401k and roll it to an IRA. So those are really your main options. Now there's a couple of other account types that we want to make sure we cover that are not what we consider employer-sponsored plans, but they sort of are, but they're treated a little differently. And the first is an IRA, an individual retirement account. Now the reason we make this a bit of an exception is because it can be treated both pre-tax and post-tax. So if you are a participant in a employer-sponsored plan, so you're in a 401k, 403b, and you can still make contributions to an IRA, but you need to do it on a post-tax basis, meaning you have money in your checking account and you can still contribute to an IRA. However, if your company doesn't offer a 401k, and so you have no ability to do it through your employer, you can make a contribution to an IRA and potentially have that made on a pre-tax basis. Make sure you contact your accountant or your CPA to verify, but in most cases that's what we see participants do. Now, one caveat to that is we do have clients that have money in an IRA on a pre-tax basis and money they have contributed to an IRA on a post-tax basis. Whatever you do, make sure you don't combine the two together. It becomes a little bit of an accounting nightmare. Just make sure you always keep those separated into separate IRAs. We'll get more into that conversation when we have our blog around specifically IRAs. But and if you've got questions on that, just look it up or Google it or whatever. You'll find out what I'm talking about, because the taxation is treated a little differently. The second account is a Roth 401k. And the reason I say that's a little bit different, yes, it is part of an employer-sponsored plan, but you make contributions in the Roth 401k on an after-tax basis, meaning you take $1,000 and you're going to contribute that to a Roth on an after-tax basis. You're taxed on your check, and then your contribution comes out into your Roth 401k. Now, why would somebody do that? There's lots of reasons. We're going to specifically talk about Roth IRAs in another series, and we're going to talk about why it's important to consider that as an option. The third account type we're talking about, and probably the most misunderstood account type that is a pre-tax account, is an HSA account, a health savings account. Now, don't mistake this as a flexible spending account treated totally differently. This is an HSA. Now, there's a little bit of a caveat to who can participate in an HSA. You have to be a participant in a high deductible health savings plan. That's number one. Number two, there's contribution limits. There's $3,700 for 2019, $3,700 for an individual. It's $6,700 for a family, I believe. But when you make contributions to an HSA, again, it's done on a pre-tax basis, just like your 401k, 403b. It's invested just like your 401k, 403b, tax deferred. Here's the little bit of a caveat. On distribution, as long as the distributions are made to cover medical expenses or healthcare costs, those distributions are tax-free. Now, if you take a distribution from your HSA for non-medical reasons, it's treated just like you took money out of an IRA, which means it's taxable based on your current tax rate for that particular year. So the HSA, very misunderstood. People don't use it to their advantage. We're going to have a whole series on HSAs and how to use them, how we talk to clients about using them. But the purpose of today, really, or this series, was to talk about the different account types on a pre-tax basis, how they're treated, contributions, how they're treated, how the growth is treated, and how the distribution is treated. Now, the reason we talk to clients about this, it's incredibly important to understand not only the impact to you today making the contributions, but let's look 20, 30 years down the road and look at the impact of saving on a pre-tax basis to you at some point in the future, typically when you get into retirement. And so again, if you've got any questions about pre-tax accounts, how they work, should I contribute to it, which account type is best for me, give us a call. You can reach out to us. You can come in and schedule a one-on-one meeting with us. We're happy to do that as well. Next week, we're talking post-tax accounts. So make sure you turn into that, and we will see you next week.